Hi, Alpha Team. Weekly preview, 26th of Feb 24. It's another interesting week. The roll call for the markets, I'm calling it. We might have to ask the Pew brothers, and we'll explain who they are as we go along. So there's quite a lot happening. It's the end of the month. You're likely to see some defending flows around stock index limits as a result of that. There's a huge slate of US Treasury and corporate bond issuance, which the markets have to see off. Rates may be under pressure, and it's inflation numbers across the globe from Japan, Europe, and obviously the PCE in focus on Thursday, and is likely to be the setup for the whole week. On that, just be aware that we're expecting a strong number. We've talked about it quite a bit, but the base effects may be dropping off to keep the annual rate okay. So we might have a bit of a mixed message. Again, sits with what might be a flip in trend on the dollar and commodities, and might see the bottom of some consolidations. All to be discussed as we go along. The sense I get is that a lot of people are very frustrated that they've missed the rally. It's very easy to talk, as we've mentioned on previous weeks, about it being the top of the market, and that may well be the case in the short term, but medium term, I think we've got the perfect setup to keep pushing on, and that, again, that will explain why. So within all that, there are some kind of anomalous advanced decline numbers. People suggest that when you get new tops, it should be on all singing, all dancing, everyone breaking out. But often when that happens, everyone says it's too exuberant. So the fact that we're inching forward, it's not hitting new highs on negative ADs, it's still positive. I think it's a little bit of sour grapes going on. And, continually comparing this market with the 2000 tech market bubble, completely the wrong way round. That was based on a lot of small caps, melt up valuations, everyone coming to market saying, trying to catch the trend, just buy it. Everything. It's the tech boom of the 21st century, and you've got to be on it. Don't miss it. There's very little earnings around, and money was extremely loose and about to be tightened. So at the moment, we've got the complete opposite. We've got a tech upgrade cycle. We've got companies making tons of money, growing. Their outer years are growing, and money is deemed to be pretty tight. We go on and on about it. We're looking for rate cuts. So it's a complete polar opposite situation, and therefore, I think you need to look through it. And that outer years idea is interesting. So when you're valuing stocks, it's supposed to be discounting the future. We're in 24 already, so we're very soon going to be looking at 2025 earnings for doing that. The indices are made up of all the stocks, so it is important. So bottom up, you're going to start looking at some high numbers that are being upgraded in 2025 and beyond, and the rating that the market has for the stock currently. Once it moves into the next year, then that has to have a catch up. So that's why you get the prices moving up to catch up with the earnings. It's called a re-rating. Another important thing I noticed this week, there was a chart going around about the actual shorting levels out there in the Magnificent Seven. So, just in a general market, you'd expect people to lend their stock. So this is a way of earning extra money if you don't know what it is. And people have to lend stocks in order for you to buy them. So if you want to short, you have to borrow the stock to fulfill the obligation of your trade. So this is a moot point that everyone has to get their heads around when you first start. How do you sell something you don't own? You have to borrow it, but you can't do that for free. You have to pay for it. So there's a stock market, and then there's a stock borrowing and lending market beneath that. And generally, the stocks would be anything from 3 to 5% would be an average amount of stock. The Magnificent Seven are running on sort of 1% short interest. That means nobody wants to sell them. So that is for a good reason. That's not necessarily something to be scared of. That's people acting rationally. So, does that mean that we're overbought? What needs to happen is something that I learned from a very experienced stock trader in the late 90s. And that is that when you've got these breakout stocks and you want to keep momentum going in the market, you need to do something quite perverse, which is sell some stock. Now, you've got the classic situation, such as with insiders, if they're selling, you should probably take note, but it depends what reason they're doing it for. If you've got the bulls selling the stock, what's tending to happen there is they know that there's pent up demand. There's lots of people who missed out, and you want to try and get them in, but they're going to give up if they don't feel that they can ever get access to stock. So it's quite sensible to let a little portion of your stock go, feed the buyers, and it also means that as that stock uh, has a little consolidation, you're in there and are able to rotate and trade and what they call jobbing around, and it gives your whole holding a bit of support and momentum at the right time. So I think that is what we're going to see. There's been big moves up, lots of gap movements to the upside in the Mag 7, in NVIDIA, etc. And I think people will just let little bits go. But that, as I say, that's a positive trend. We want to see the trading of the stock. I mentioned the Fire Brigade and the Pew Brothers, and we'll again focus on that later. But basically, the talking heads have been out pouring flames on what could only be the embers of the inflation fires. Really, we'll find out over the week if there's any real worries on that data side of things. But to me, we're moving very much towards a kind of global risk-on environment. As you get into the end of Q1, Q2, seasonality on the dollar is that it's weak. What you tend to see happening there is people letting the money go into emerging markets, other markets. When you could even call a FTSE an emerging market, the way that no one's got any interest. So you'd like to think that this broadening of the rally will occur, and it'll be overall you've got a risk-on situation with the dollar weakening, and we think that could be 5 to 10%. And performance across the globe, and you've got lots of reasons to still be investing in Japan. Berkshire Hathaway over the weekend, the Sage of Omaha, another massive outperformance, loads of money being thrown off from the inflation, the insurance side of things. He actually mentioned inside the commentary that a lot of Japanese stocks, particularly the investment trading houses, are much better quality than a lot of the US banks. So he's very happy to put his money over there. So that will only encourage further flows, I think. And another important thing he said, he didn't necessarily talk about things being overvalued, more that they've got tons of cash, 170 billion or something, because there are no outstanding opportunities at these levels. He's waiting to buy on the dip. That's what I'm saying. There's lots of clever money waiting to come into this market, given the chance, which should make the pullbacks shallow and supported. So I don't think it's a panicky top of the market time. And when you get those situations, you never get in. You're there, you're sat waiting, you've got a plan, and it tends to never give you a chance to get in. Lagarde popped up again, talking about wages being an encouraging trend, just to tease us. Nagel jumped all over that. We'll deal with that in the talking heads. And I suggested it last week. They're setting themselves up that is the figure they're looking at. They're expecting some weakness in the sort of Q2 reading sometime in April, May, and that's when the ECB will probably go. So we had a lot of indices making their new highs over the week, including in Europe, the Stock 600, 5 weeks in a row. That's continued to push on. There's a new acronym knocking around, which is the Granolas. We'll look at that another week, which is the largest stocks in Europe that they're trying to present as being equivalent to the Mag 7 idea. That's something that will hopefully develop over the coming weeks. German GDP was down 0.3 in Q4. We've got a reading coming up pretty soon. What will that mean for the Eurozone as a whole? That Germany is the driving force. If there's any kind of signs that China are picking up, they are the number one exporter for Germany. So the German market is breaking out. Looks like it's got the potential for a double whammy. It's got a bit of tech, and it may have a manufacturing uplift. We'll see from data later on. It had a bad week from the PMIs last week, but could it be the low? The IFO came in quite supportive after that. And then there's going to be lots of rotation going on. We mentioned last week how the earnings was quite weak in the resource sector, and it's become so pronounced versus luxury outperforming in Europe that Bank of America are suggesting switches. So that will fit in with a weakening dollar in Q2. So let's have a look at how last week went from a data point of view and the talking heads. Monday looks dull to me. And so it proved. Sometimes we all need a day off. Last week was it. Monday was probably one of the worst sessions for some time, pretty dull. But, we had, everyone was really sat back waiting to see what happened with NVIDIA, weren't they? The UK Rightmove index was about the only thing out on the day. That sneaked up in line with seasonal factors. The EU launched Aspides, which is their defence force in the Red Sea. It's the Greek for shield, Aspides. That was the most pronounced news, really. Moving into Tuesday, China did go ahead and do a rate cut. We'd said we expected them to move the 1-year rates on the Sunday, which they failed to do, but they did move the 5-year down by 0.25% instead of 10 bips. So that started off trying to get a bid into the market, but it sort of drifted off during the week. Wednesday, really big day for stock updates across the markets that we look at. In the UK, it showed you how concentrated that index can be. We talked about heavyweights reporting. So we had HSBC who missed, Rio's in line to a miss, Glencore's a miss, BA Systems, Travel and Arrive. But the 15 largest weighted stocks in total make up a huge amount of the index, and they were responsible for just about all the move on Wednesday morning, and it didn't really matter what the rest were doing. In general, resources were under pressure, following on from that previous Billiton miss that we'd seen. But the Rio guy, Jakob Stausholm, the CEO, he was saying that even though he wasn't the guy that called Supercycle, it's the basic backdrop for resources is supportive, and he thinks that they've got a cupboard full of opportunities, that there will be M&A in the sector if the prices are right. Underperformance due to a lot of the metal prices hanging back, that should correct itself and should help with a bit of that risk on for Q2. It's somewhere that people may start letting some of their tech stocks go to move into other areas to support it, and some of these stocks are quite heavily weighted in the indices that they're in. Japan, as I mentioned, is close to a top, and they are, well, we'll mention that in a minute, but they may be doing something quite clever in the tech space just to have a little bit of supply, a bit of support as they eke out a 35-year new high. You don't really hear that mentioned very often. 35 years to get back to where they were when they were the leading economy in the world. Oil, I was hoping for the breakout to 82 to start showing its face. We tracked sideways, as we'll see in the chart below, and a lot of focus back on the lack of demand. But it won't take a lot just to eke out that top before we finally drift away again. It's not necessarily helping us as consumers, because there's ever such a lot of maintenance on the refining side, which is causing pump prices to pop up, and that will have an effect on some of the headline CPI rates. So just be aware that the oil thing needs to work its way through the data in the next couple of months. Outside that, gold and the dollar are still flirting with new highs and bottoms. We'll have a look at the charts. Caught me out a little bit. Ironically, we had some videos out on Friday talking about confirmation bias, and I've walked myself straight into it. I'll talk you through it later on, and had a shocking day on Friday thinking I was master of the universe. So back to NVIDIA on Wednesday. Reports hedge funds had been fading the stock. As I mentioned earlier, some clever people will be letting stock go ahead of these events, just so that it gives them an opportunity to buy, and it also locks in some gains. Lots of option trades, 10% above and below. Again, those are good ways of earning extra money, or if you've sold a put, gives you a way of being forced to buy it at a lower level if it comes off, and guaranteed, as opposed to seeing yourself get wicked and never actually being able to buy any supply. Talking heads on Wednesday, Bailey was in front of the Treasury Committee, and he said that they don't need to start cutting, but he's happy with there being a cutting profile in the rates markets. Broadbent also started talking about hoarding labour ready for a GDP uplift in the UK is what's causing the wages problem. And Swathi Dhingra, who is an external rate setter, it's not part of the Bank of England, is just beginning to say that if they keep rates too tight, they're going to create this self-feeding loop of supply chain problems again. So, and I think Bailey later on in the week also said we don't need to wait to see inflation at 2%. You do need to start going ahead of that, and that is a trend that we need to see more people talk about rather than just pushing it away. Because if you do that, by the time you move, you'll be in trouble. There looked like there were good signs for the Tory party during the week, with the UK budget deficit falling, but that was really due to borrowing forecasts changing. So the amount of real money available, not necessarily there, and actually the tax take was small down on the year. So if anything, nothing done for Hunt in the March. Then he'll try and play around at the edges, but he might not have a lot of room. It is last chance saloon, so there might be a little bit of positive commentary around going into that, but whether he can deliver is a different matter. And there's still a lot of money just going backwards and forwards between the Treasury and the Bank of England on the balancing out the quantitative easing slate. Eventually, that will end up with a giant loss for the Bank of England, but at the moment, it's actually a positive. And then what I was talking about with Japan's started going on about their Rapidus project, which is a brand new semiconductor AI chip thing. They've already thrown 26 billion at it. They're going to double that, and it will obviously become a quite large stock within their Nikkei 225. And so I was saying, just as they're looking like there might be an excuse to say, oh, it's topped out, they've just put in a new high, there's every chance that powers ahead. If you the emerging market money that's we're expecting to hit the market, that, and you're worried about China, a natural home is going to be Japan. And for the domestic investors, this whole point, if we can get any kind of unwind on the carry trade and money comes home, then they'll throw it into the Nikkei. And if they've got reason to earn, they can earn money at home, all well and good, and it all becomes a self-fulfilling, self-feeding up cycle. Made a naughty comment there. The Bank of England banknotes will have King Charles III on it from June the 5th. Is it too early to say, will he make it? I mean, not shocking. Absolutely shocking. And the talking head, US Bowman rate cuts, certainly not now, she said. But the main thing that she was talking about was criticising the plan at the moment. Money's a bit tight. They're trying to hold off on the rates, and they're making the banks hold excessive amounts of cash. She's worried that might have a feedback loop. And then obviously the big boy, the daddy boy, NVIDIA, after hours, it beat. Gerard put a table up, and I've summarised it there. Just look at that trend since 2020. Revenue's 11 billion, net profit 3.5, 5 times the revenue now, and the profit's up 10 times. This thing is exponentially growing. This is the whole thing, and this is just reported. So if their actual outlook, as I mentioned, for 25 and beyond is growing even further. So that, again, self-fulfilling rate cycle, you're buying genuine outperformers. It will support the market. If you ignore it, if you haven't got it in the portfolio, you're going to underperform. So, there's people desperate for a pullback. They absolutely want a pullback. Will they get it? And then, this shows you how crazy the world's got. In pre-market, before Thursday's open, NVIDIA was up the whole market cap of the biggest stock in the FTSE, Shell. So they're up 200 billion. And in the end, if in US terms, that's putting on a Pepsi. I mean, what their slap line for 24 is rise up, baby. You don't say. And then at the open on Friday, NVIDIA went again and was the first company to hit $2 trillion market cap. Absolutely crazy numbers. Yeah, some people are looking at and saying that that's almost a quarter of US annual GDP, 7 or 8 trillion. But it's the wrong way of looking at things like that, because this is a genuine company that is seeing massive inflows and absolute brand new technology. Yes, are we seeing the true benefits of what it does? Not yet, but it's allowing people to think outside the box, and it will backfill. This is a technology that isn't going away. Those kind of cash flows will be generated. So, as I said, new highs across the board. by the end of the week, just about everybody had put in a new one, apart from the Nasdaq Composite, again being used as a reason to say that it's not a broad rally, but that will catch up as people see opportunities. Yeah, so reasonable comments. I've seen you don't get 2 stellar years in a row, but you tend to get the presidential year 3 followed by a positive year 4. It's just a case of how much, and keep going on about it. I think ahead of all the shenanigans we're going to see from Trump, we need to get that performance in by the end of Q2 in the first half. So this is all setting up to me for another breakout as we might see consolidation here, as we go into the start of March. All depends on the data, but as the data from February comes through, if it doesn't confirm that inflation trend, then we are really off to races. This is all about growth, and if you get any kind of rate cutting cycle back into the game, that's just the cherry on top. Keep going about it. Growth beats rates. Don't fight it. We had oil API US inventories last week. They grew by 7.2 million barrels in the week to February 16th, much more than the 4.3 expected. Again, that just double whammies it for oil. So oil was stuck around the 77 bottom of the consolidation channel that it's in. So you've got weak demand and oversupply. It's not a great combination, and the geopolitics is relatively calm. Last week we went into it saying that the PMIs were the focus, and we'd see that delivered updates across the board. I've done a little summary there of what the prints were for this month, from Australia through Japan, Europe, UK, and US. It's red if they were lower than last month, and blue if it was higher. So you can see there's a trend in general for manufacturing to be weak and services to be positive, and the composites in general to be positive. But Australia and Japan still struggling. If you're below 50, that means your manufacturing base is obviously contracting. 45 is the real problem, and there's only Germany below that, but there's every chance that might be bottoming soon, as I mentioned. And surprisingly, the US blipped up on the manufacturing for the S&P. Important for this week because we have got ISM manufacturing on Friday, and we've seen from the Philadelphia Fed and the NY Fed, the prices paid elements have been quite hot. So it might just be that this week is it's the one that everyone fades the market a little bit because the data might come in hot. If it doesn't, that's another reason to go off to the races towards the end of the week. But obviously we need to see the whites of the eyes and read the detail of those things. But the setup is that manufacturing might just be ticking up stateside. The print for the UK was a good trend. It was an 8-month high. We talked about it on one of our memes. No Blue Monday in January, mainly due to new orders. US PMI, as I said, 51.5. That had actually had a little composite blip up overall due to the relative weightings. But in the main, the subcomponents, it's a real mixed bag. So we need more evidence, and ISM will give us that on Friday. And then aside, get ready for more action. All the privatization of the moon well advanced. Has always been these rumors that we're going to start finding minerals up there, and they managed to, NASA's private venture, put a private plane module back on the moon. So as long as you believe that the moon is somewhere that you can land, and you don't believe in all those conspiracy theories, then it's back in there. And look out for further info from ACG about how we're going to use the moon. Talking heads, they're always around, and I've mentioned it before. We'll start that one again. So we've got talking heads last week. I'm referencing there, it might be worth, I'm not allowed to play too much of it, but I'll give us a snippet in a minute. Pew Pew, Barney McGrew, Trumpton Fire Brigade. You got lots of talking heads out there, and when you start listing them, they like Jefferson, Cook, Harker, and Waller. It sounds like the Trumpton Fire Brigade roll call, and all they're doing is coming out and pouring cold water on anybody who's slightly bullish. It's quite dull, really. But the one that caught my eye was the Vice Chair Jefferson. And I was just saying Jefferson Airplane, which reminds me of that beautiful White Rabbit psychedelic song that they use in The Matrix. But to me, he sounded like he'd already taken the blue pill and he's in a different parallel universe. He was looking back to the 1990s and the perfect soft landing of the previous vice chair, Alan Blinder. Now, if that's what the Fed are thinking, what happened there was that there was one rate cut and they followed it up with another one, but 3 months later. So, keep that at the back of your mind that may well be the playbook revealed by Jefferson, who obviously is the vice chair to Powell. Cook, she's looking for convergence of data and a rate cut if the balance of all the data shifts appropriately. Waller, he's a big hawk. We've done a meme about him overnight, talking about is the inflation data a speed bump or a pothole? If you lived over here, you'd see nothing but the way you have to tiptoe out of my village. It's quite scary. The amount of tyres that everyone's going through, ridiculous. But yeah, we'll see. Is it what he's basically saying there? Is it a one-off set of bad data in January, or is it actually something that's going to derail us and push us back? Harker doesn't want to unwind too early. I mean, to be honest, it seems to be the same old mantra, but different people saying it each week. It's like they're doing a sweepstake of who's going to speak next. Then Mohammed El Ryan, who used to work with Bill Gross at PIMCO and was a big talking head through the great financial crash. He's always on Bloomberg for a bit of sensible chatter. And he's quite rightly saying that they've got to be careful here because they were behind the curve in 21, went too late. I've mentioned that. And, if they haven't sorted normalization out by June, they've missed the boat and it will start to look awful. And there's a good chance that they make policy mistake. Holtzman, the Austrian central banker, said that the ECB are unlikely to go until after the Fed, which was always my idea. And Nagel, who's the Buba president, we've seen him, he's super hawk, should avoid all temptation to cut rates. He thinks wages are still too high before the crucial data, echoing what I've already mentioned about Lagarde. And he's also pushed back about timing anything relative to the Fed, saying that it must be solely on what's happening in the Eurozone. So clear as mud, but I still think they've lined themselves up for June, whatever. Schnabel, she spoke twice over the week, cautious about the economy, but really there's no rumours of there being a rate hike at all in the Eurozone, whereas some people have changed the narrative in the States to, or trying to focus on the fact that does this mean that there's still a chance of another rate hike? Totally unlikely for my line of thinking, but you never know. UK consumer confidence slipped back again. Previous month it had a little tick up of being less negative. We're back on the lows again. But some of the underlying had said that Rolls-Royce could be interesting as a driver for industrial pickup in the UK, and that absolutely smashed results. Standard Chartered, similarly, massive buyback, a little bit of, obviously a lot of Asian exposure there. So, net, that's two areas outside the US that are showing that there might be reasons, even more reasons to see a little bit of, broadening of the rally. We also waited for the Russian sanctions on Friday. We thought that they may possibly have an effect on aluminium and some of the other metals. Might have been a reason why the gold was putting in such a strong defense on pullbacks, but none of that. They just focused on 500 individuals and a lot of technology and military grade specific sanctions. Obviously, it's good for helping the Ukraine, hopefully, but not much use for us market wise. And overnight into Friday was a big miss on New Zealand retail sales. So that whole region is just having a little bit of a pullback consumer wise. So what have we got during this week? As I said, the fire brigade is likely to still be on standby with the inflation data coming out. I've mentioned Berkshire Hathaway over the weekend. Not much again today, but you've got Japan inflation tonight after going into the Tuesday session. There's talk that may dip below target, but it's again a lot to do with the base effects dropping out, and next month there'll be a rebound. technical rebound anyway. So the rate chatter will be back on. And obviously going into March, we're looking out for that Shunto wage settlement, aren't we? So keep that back in mind. Tuesday gives you US durable goods. Why is that interesting? That is basically business spending. If you strip out the defense and aircraft spending, that gives you the underlying business spending, investment spending in the US. So that is a number that's often looked at. And you've got the house price data and the Schiller indices there. They're normally well watched, and we have recently had quite a bit of mixed data, slightly weak data in the US housing side. We'd like to see that start to consolidate. New Zealand make their rate decision on Wednesday, so that's the Asian session for us. We've got Australian CPI and GDP, and Japanese have got their retail sales. Well, we already know that was the weak part of GDP, so we're looking for any kind of uplift coming through from that. Thursday, quite busy Euro-wise. They've got retail sales and loads of regional and country CPI data, the inflation data, UK money supply figures. We'd like to see the pullback in that steadying and trying to see evidence of what they call the multiplier effect. People beginning to use the money and invest it, create some momentum in the market. And then it's all about the biggie US PCE in the afternoon. We mentioned the sausage machine guys straight after PPI last week, and that's suggesting 0.4 on the month. The consensus has gone up to that, so we're well on board. But there is some factors in there that suggest those base effects may roll off to keep the annual core rate still below 3%, if that's the case, unless PCE misses above point or spot 4%. The market may well take that as a good sign, and it could well be the signal for risk on at the start of March, and the dollar actually being in a downtrend, which we'll have a look at in a minute. And again, S&P Global PMI manufacturing was upbeat, services was soft. We've got ISM on Friday, and the services, that means, will come out on Tuesday of the following week, but we'll look at that in next week's preview. So into some of the charts. Dollar strength, January and February, all else equal. I've mentioned that's a seasonal effect. Should have expected that all along. So we're looking for the dollar to top out. That's always been the picture. We've been forever messing around with, is it extending? Is it topped out? Currently, it looks like we may have topped out into February the 14th. I'm looking for the pullback from that to be a connector. And if anything, at the moment, we're doing a consolidation up into around the 104.5 area before we sell off at the end of the week. If not, we probably do put in that move up to 106. Either way, we're talking about being in the latter stages of the consolidation, and the next move is a pronounced bit of dollar weakness, unless something material changes that view. So we're either doing a little bit of nesting. It's not it doesn't look that much of an impulse, but you have got these little shoots down, which are the ending parts of the individual consolidation waves. But if this keeps nesting 1-2s, eventually you get a large one, and you have to read that as being an impulsive move down. So be very careful, but look to play the extremes. 104.5 is probably worth a sell with the last high, the previous high, as a stop loss. We may get that breakout, and then that will change all the underlying patterns. We know that PCE is set up to be strong, so that has left us with a bit of a pivot point around that piece of data. Euro dollar, mentioned it last week. Looks like we had that breakout we had that hit 1.08881. It looked like we were going to have a breakout. We had one, chased a lot of people up, but that, by the look of it, has put in a 5-wave channel to that top, of which we're doing a consolidation pattern before. If we're right about the dollar selling off, the euros go to new highs above that current breakout level from last week. So looking for a 1-for-1 and equals leg down. There does look to be a bit of supply just around the top of this consolidation range in the low 108s. I'd like to see, as I say, 107, 500 tested. It may go a little bit below that as we work our way through the data during the week, and then we're off to the races. I think. Keep an eye on that. Obviously, we know if it's consolidated here and goes again, then we've put in a truncated three wave. But that's something to look for on the back foot. First instance, most aggressive is to have the three wave consolidation and then go. Japanese yen played around in that. That again, we were earlier looking for this to be a three wave into the two low. We knew there was a big support zone. It was all about just being below the 38 fib. Bounced straight off that, just a wick touching down, and then we've been putting in a five wave again over the week. Lots of sterling strength. Sterling's been trading like a pseudo dollar, particularly because the rates keep getting pushed further and further back. I'm still worried about the yen not being as soft as it looks, but in the short term, we'll play it until that trend reverses. Again, the argument here is all about, have we got a three wave that has stopped here at the spot 618 retracement? We're looking for a consolidation and another move down, excuse me, to do the one for one. If we can break through that support and then around the 1 to 1 spot 618 expected kind of defense channel, there's a huge amount of support in there just below 190. So keep an eye on that. Looking to buy into the pullback. Swissy Japanese yen, another one that played off that support, that resistance channel there. We've had a couple of looks at it. I think we'd played a short into this low. It's been bought again. I'd like to see my mouse work. Again, looking for the full consolidation in the Swissy yen to be a one for one. There does look to be a bit of supply around the 38 fib, but I think that will eventually hold, and we'll see this move down to the sort of 170 level. But again, everything depends on how we play out during the week for that whole US dollar yen play, because it could get a double whammy of the weakening US dollar and strengthening yen, in which case this thing really does start to look interesting, because if we go down to the 1 spot 618 level, it might actually be the start of an impulsive five wave. There'll be more downside. So keep it in mind, this isn't just a continued one-way bet to the upside. Keep saying it. It does look like we're consolidating at the moment. So indices in general, I'm saying it's deja vu all over again. We had this pullback on the banking crisis, the SVB, Silicon Valley thing last March. Now we've got people trying to talk a crash on the back of a breakout on positives. Big tech, large tech. I'm invested with some people on part of my pension. I went with them mainly because they were positioning for large companies, tech, which gave them a US bias within the world, MSCI world bias, large companies dominating everywhere, and to the detriment of small cap. And that is what we are seeing. Lots of, in the MSCI world was part of that group that hit highs this week. I say it's very easy for you to create a bearish argument, but I just think it's mainly because you've missed it. People are trying to talk it down. I've talked about the lack of selling in the Mag 7. Is that bullish or bearish? I'm always looking for cartoon physics of things over the edge and looking to fall right back. Obviously, we've got one or two indices that have just gone above their upward trend channels. You'd like to see them come back inside that, but we'll have a look in a minute. It looks very much like they're going to come back to decent support levels. As good. We may have put in some wave fours, which are natural trend towards points on pullbacks. And the market will look after itself. Tesla shows you what happens if you miss, and quite rightly they got smashed. With the others, they've not, and they're so heavily weighted. It's difficult to play those shorts because the heavy portions of the market are against you. We've seen it for a whole year now. you're fighting, the power of market cap weights. I'm talked about there. We're waiting to see the gamma hammer come crashing down. So that's the options side of looking at things. Because we've moved up in a fairly orderly way, people will still be selling puts and calls, but that means you need it to be orderly. You can move around the average there, but any kind of big breakout, all of a sudden, if you're the market maker and you're the wrong side of those positions, as the market comes off, you're getting longer and longer, and as it goes up, you're getting shorter and shorter. So you're having to chase or smash against yourself. Obviously, if you can be long gamma, and that's putting on a vol trade. We'll have a look at that one day, but it's a bit complicated for today. But there are certain ways of benefiting from moves, whichever way it goes. But until something happens which creates this breakout move either way, I'm find it difficult for the market to pull back too far. Boom, boom, boom. Germany, I know. Hello, Teacher's been playing that. He was on the chat and he's been eking out gains with his pitchfork. This red line here is the channel of the larger degree waves, and Germany's managed to eke out above there. We've said for a number of weeks it's nesting. Would we finish the 3-wave move on the channel, or would it do a double and come outside? Well, we managed to get down to a channel for Wednesday, just like a number of indices, and then since we've had the breakout to new highs, so we're quite happy with that. So I've also put in there, if that's the right case, this wave here has got a bit more upside between 17,800 and 18,000, where the 1.618 breakout meets with one of the other subwaves from the high degree. So there's a little bit of matching up to do there. I'd like to see another little boost up there to put in a third wave. This is, if you look at it on the count back, you've suddenly got, we're in a third of a third of a third of a third. I've talked before about how you get all the powerful moves in that. It's going to be very hard, unless something material changes, to not get an impulsive move up pretty soon up to this kind of, and it'd be nice to put another big marker into the DAX index at 18,000 print. I'd be delighted to see that. FTSE, it's really going nowhere. You can see this longer range chart here going all the way back to the start of 2002. We've been in this channel, very, very protracted, complicated WXY to make up the B wave. Eventually, that suggests there might be a bit of a pullback later in the year. It's been left behind, but if we've got this momentum in the Q2 outflows, people may well have a little play into FTSE again. Something you're looking for when you're investing overseas is for the local currencies to be strong in wherever you're investing. So if the dollar's becoming cheap, it makes sterling will end up in that basket of stronger stocks. So you get a double whammy. You get the investment performance and your currency performance, depending on where you're investing from. But there's so much apathy and disinterest in the UK, lack of tech stocks. It's just not interesting. But if that's something you want to play, look, you've got 4 to 5% of potential upside coming quite quickly. The Nasdaq, what I've done here is we talked about it doing a double correction. Will it stay or come out of the channel and return? It did that, but what that does allow us to do with a double consolidation, almost perfect down to the 1-for-1 that we're looking for, below 17,400 last week. It did that and bounced. Actually, during Wednesday, going into the results, we started this little blip up, and then you've seen what's happened since. Allows us just to move the fib channel to incorporate 2, 3, and 4, which nicely brings us to where we first posted and had that confluence of 1.618 for the third wave. So it very much looks like that's all coming to fruition. We should have a little channel top before we put in what looks like, at the very worst, we'll have last week's low of a wave 4 of the minor degree will be a support, but highly likely that we get a lower a shallower one than that. But even there, we're not going to be too concerned. That'll be 3 or 4% pullback and off to the races again. We should get this upside completing of the nests of the 3 4s and 5s, 3 4s and 5s, all the way up to what we originally had the idea. So 19,500 could be an ultimate kind of half one top area that we're looking for. But I'd just like in the short term to get this little channel top in there, get the pullback, and then we can see whether we break that channel here and just how far it goes. 19,000 is the, most likely we'll end up pulling these down a little bit, I think. The Dow's interesting. There's a lot of fundamental shenanigans going under the hood. You probably saw it, but Amazon is now coming in to replace Walgreens. The Dow is a strange index. It's a geometric index. It's based on price, not market cap. So your share price is the most important thing for them. Historically, they haven't had a lot of tech, but with Amazon coming in, they'll now have Apple, Amazon, and Microsoft in the 30 stocks. Starts to get interesting. The reason that this has all happened is because Walmart, worried about their stock price, decided to do a 3-for-1. So that massively hits there and gives a false kind of negative into Dow. So they wanted to get a double whammy going there, more tech and higher prices. Managed to eke out an all-time high. Some people say that it's a death knell for growth stocks when they go in the Dow. There's a history of outperformers going in and never seeing their highs again. But is that the case? Jeff Bezos has obviously lobbed a load of stock in, but is he one of our punters? Is he one that is doing that so that he can support it going forward, or has he got another personal settlement to sort out? Who knows? But what it does look like is, I just talked above with the Nasdaq, the 3, 4, 5 that we've put in with the overshoot. People are saying, is that an exhaustion gap? Because there are a lot of underlying negatives, advanced decline, oscillator, divergences, as you can see here. But, it's quite a shallow pullback you had there. I think that suggests that we're going to have a consolidation into that previous fourth low, and then we move ahead. That is a classic setup of people misreading the slowing momentum. Yes, it's natural, but we're going to go into the safer hands. People that are desperate to have it, and may well be people just trading it. This is super setup classic for everyone saying that is a massive sell-off. Is it overbought? I don't necessarily think it is. Like, you've had this waning momentum, but it's pretty much around flatline. If that was the divergence, I'd like to have seen it coming a lot lower. And you haven't got the absolute peaks in. The waning MACD momentum as they put in a fifth wave, that's a classic that you should be getting the third wave, seeing the peak of momentum. And that is the classic of putting in a 5-wave move. So you should have a consolidation coming. But unless we start to see a massive negative on the advanced declines, it's not going to be too deep. S&P, again, we're just hugging this channel. Again, we could have tweaked that just to include the latest low, but there's no real need at the moment. We're still eking out 3s and 4s. And look, all these huge sell volumes that took place, and they're getting eaten up on subsequent sessions by the buyers. Stocks trading above the moving average, that started to show some impulse to the upside again. We've had good reports. It's not, unless this turns down and starts making another new low, it's unlikely that the pullback is going to be anything serious. If anything, we eke out within the channel a few more gains, but it might all be hidden within. We might still be doing a consolidation pattern here with an expanded flat within it before we break out again. But I can't see any reason at the moment not to think we're still going to keep rotating to the upside. Oil, we mentioned it, the weak demand, excess supply, that's keeping us in this choppy channel. Still looks like a connector, still looks like the 1-for-1 takes us to 82, 83. So look out for any positives for us to do that, or if there were to be a dollar negative, then that will suggest that we've put in a top here and we've just been nesting, and we'll get the breakdown. So data dependent, but anything that isn't super dollar positive. We're going to put in a relief rally high, I think, before we eventually go back down to the fundamentals taking over. And then my mate, gold. A lot of people talking about it on the chats. And this is my bet noir, as they call it, had a shocker. So caught absolutely overnight, super call, had it all in place. Talked about the 38% fib, would have a lot of support to it. And so I'd expect a gap down, 1,000 points in the money on Friday, busy watching it. All I keep seeing is the thing bouncing. Well, that's fine because it's putting in a connector. I'm looking for a 1-for-1. Might even be, a pullback to the 2000s. Is there a pattern that suggests we'd go and test the ultimate support that we've put in down at 1984? But, we've got a downward trend line. It won't go through that. And I'm looking through. We've had two lows with lower and low momentum prints on the MACD. So, there's been no divergence. You'd like to think that if you're bottoming out there, that you'd have had a divergence the other way just to say that it was the end. So you're thinking, no, that must be part of the consolidation pattern. What may have happened here is that we've actually put in a connector, and the move up from that support to the new rally high on Friday was actually the fifth wave. That would sit better with the divergence, in which case we should be expecting this week to have some consolidation. So you'd expect this to eke its way down. Again, that 38 fib might be an area that you put in the end of the consolidation wave, and then we're off to what might be the run to the all-time high. If we've now got this dollar weakness coming into those bits of data later in the week, and there's every chance that we can call this most bullish nesting of and the test and hold of nowhere near 1973. We've got to be very careful that we're not now in the breakout to new highs on the fifth wave. So sharpen the pencils. It may be that this is ready for breakout mode. As I said, that just tells you, I think I've got half an idea. Sometimes I know what I'm doing. I've got a set of rules, and then I start looking to make things up to confirm it. Well, not make things up, but rely on things, and it can only do what I think it can do. Well, it obviously can always mutate, and you could always be misinterpreting it within that pullback. It's a three-wave move. It did have a relative. It had done enough. It was more than the spot 618. It didn't necessarily have to reach the 1-for-1. You can truncate. There were 5 waves within that third leg, which is another classic for you're going to at least have a reversal. I was thinking, that it would be held by the trend lines, and ultimately made the whole thing worse, trying to and mistiming breakouts. The whole thing ended up being a disaster, having been totally in control. How can you have 1,000 bips and then blow it? Be careful. It's very easy to get yourself in a very angry mood, and then you start doing things that you shouldn't. You should be walking away, start again, stick to the rules. And we've been talking all week about, if it does break, we're going to take on that 20, 32, 36 area. Took out that volume. It's starting to feel impulsive. We do a pullback, and it very much looks like that could be time to put in a proper buy. Stock-wise, next week's the slate is generally light for reporting. Whitbread is normally a good consumer confidence one. It's hotels and leisure. There's a bit of interesting tech. A lot of people don't look at it as Ocado. They think it's a retailer because they deliver food, but their model is all about these very clever automated warehousing setups, and that's what they're really should be looked at. So it's not necessarily generative AI, but it's a clever UK thing. Let's see how that reacts. You've got Imperial Brands, that's a heavyweight. A lot of people have that for yield plays, for the dividends that it kicks off. And we've got Taylor Wimpey showing us the state of the house building sector in the UK. EU, not many big heavyweights this week. Insurer Munich Re, the construction side of things with CRH and Sangaman stand out. US, not much left apart from the retailers. You've got Macy's and Lowe's. Berkshire Hathaway's already reported. Salesforce, that used to be a tech darling. And it's Anheuser-Busch Buddy, makers of Budweiser, is a large cap highlight. Talking heads wise, we've got a couple of Bank of England people on Monday, Ramsden on Tuesday, Balts for the ECB. And it's later in the week as we approach inflation numbers that Bostic and Williams are out. Takata in Japan gives us a speech. That'll be interesting for any clues. Nagel's out again. We know what he's going to say. Bostic, Mester and Goolsby in the States. Williams is back again on Friday. Pill is back for the second time. The Bank of England and Bostic and Daly, who always likes to round up the week for us. So be careful out there. Stick to the plans. Literally be very careful with them. And good luck with the trades. We'll speak. What I'm probably going to do is a live show on Tuesday afternoon. I'll put something on the chat, but let's talk through any of the issues that you see in this preview and any questions. Lots of fundamental questions, any tech setups that you think might be interesting for us all to look at. We'll speak soon.